Sure. So Dionne and I met through the National Association of Professional Mortgage Women. It's like the longest. It took me years to get that down, the order.
Yes.
But that that's how we originally met. And like she said, we became fast friends. But my name is Ivory. I own a company called Incite Strategies Credit Solutions, a software called Credit Score Pro, and then an education platform called Creditworthy. So really, I focus everywhere that has to do with credit. We do quite a bit of training and education for professionals, mainly mortgage loan officers, on how credit works. So that way you can close more loans, but also have those conversations with your borrowers when they're asking you things and you don't feel stuck like, oh, I don't know. And then they go to social media and find the wrong information, right? So we want to bridge that gap. My background's in regulatory compliance and default, starting with the financial crisis. So I worked on all those over leveraged mortgages that went into foreclosure and deed and lose and short sales and modifications and the whole nine yards. Um, so I got to see what goes wrong when people don't understand credit. And now, essentially, what we do is the opposite side of things. We want to understand how credit behavior impacts approvals, pricing, timelines, and know what patterns affect lending outcomes. So, really, we act as, or my company in general, we act as that bridge to take someone who has damaged credit, build a stronger credit profile, and structure them in a position to where they can move forward and not repeat history, and also get a home loan or get a business loan, and not be stuck in a vicious cycle. So that's what we do. And today we're going to be talking about why loans don't make it to closing and that how that impacts you. We really want to focus on the why. So there's a whole big section on the why, and then it's about what you can do about it, and then some real examples. So I do want to take you through real client examples, real loan officer examples from loan officers that work with us, just so it all makes sense. And like I said, please ask questions throughout. This is going to be jam-packed with tons of information. So if you need any extra details after we're done today, don't hesitate to reach out. So, okay. How many of you have had a borrower in the last 12 months who had income, had assets, had employment, wanted to buy, but got stopped by credit? I'm assuming that's happened to everyone here at least once in the last year.
More times than I can count, Ivory.
Exactly. It impacts all of us. And so today we're going to be focusing on that. I mean, just to put it plainly. So we're looking at the borrowers who miss qualifying for qualifying by a few points. What do we do to get those few points? The borrowers who had a single collection and it dropped their score 100 points, and now they don't want to do the refinance or they don't want to do the purchase because their score was 800, but now it's 680, and it's just not worth it now. We're going to talk about the clients who had maxed out credit cards. And then the big ones who have tons of reporting issues. Their credit scores are in the fours or in the fives, or maybe they're at that 580, but you just can't make it work. And then the ones who say, I just need more time. Give me a year. I'm going to work on my credit. So I like to look at these borrowers as it's just a not right now. It's not a true denial. It's just a delay in the process. But we want to shorten that delay as much as humanly possible. And so we're going to go over what that looks like. So I am not a mortgage loan originator. So I'm doing my best on what I assume commissions look like. So we're going to run with my numbers and you can adjust it accordingly. So if we think that the average mortgage is about 550,000, and you lost about 5 loans, that's about 2.75 million lost in production. What would one more funded loan per month mean for your business? So if you can capture that lead fallout, how much more can you do in production, and what does that mean for your bottom line as well? So most often what I tend to come across is a lot of originators are looking at trying to find more solid leads with good credit, leads that fit that perfect box that we're looking for. But there is a variety of clients available in your CRM that already exist that could be captured that are just falling out right now. But if you had the tools and the resources to actually help them, you would be able to close more of the loans from the leads that you already have. So if we actually look at the data, so we want to look at what causes pipeline fallout. So we're going to start from the inquiry to the closing. So if we have about 70,000 mortgage inquiries annually, not all of those turn into applications, right? A lot of people fall out. They just, maybe they weren't really serious. They didn't really want to buy. They just kind of wanted to learn about the process. Only about 46,000 of those people actually submit an application. But then from application to closing, only about 25,000 people out of that 45,000 end up closing. And when we look at the major driver for a denial, 59% of mortgage denials are credit and debt to income ratio, with about 25% being credit and the remaining being DTI. Now, we can't hide from the fact that DTI and credit really go hand in hand, right? If you have credit issues, you're typically paying quite a bit more for your debt. You're probably going to have higher DTI. Your payments are higher. You may be relying on credit cards more. Yeah. Oh, sorry, I just missed an old chat. Ignore me. So this is an opportunity that I think a lot of people overlook. This is fixable, the credit piece. And the DTI being a symptom of the credit piece is largely fixable. Now, we can't change income, right? That's something we cannot control. But if they have sufficient income and there's just a debt issue and a credit issue, there's a lot that we can do. So let's look at what the credit environment is doing right now, because I think it's really important to understand.
Avery, can I say something really quick?
Yeah.
I always love to bring up in these situations, like Ivy just gave you guys probably one of the best talking points when it comes to bankers, to credit unions. You meet these people, you talk to these bankers, if they cannot do the loan, then now you're in a position to not only do it, but to help their borrower get to the next level. I know it sounds like a lot of work, but I am telling you, it is not. Remember, Fannie and Freddie are not score driven anymore. And remember that once you get the information, once you start working with Ivory, getting them over that FHA hump is going to be a little bit easier. I'm sorry, I raised my hand.
No, I want you to talk.
But that was so good right there, because it's I'm telling you, it's not that hard. Even some of the stuff that she's going to tell you is going to just, I know it blew my mind, and I'm an underwriter, so I'll stop talking.
No, you're good. And this percentage, oh, whoops, I clicked. This 59%, that's as of that's a 2025 statistic. 2024 it was just under 59%, and then 2023 it was 56%. So it's climbed a bit over time as far as primary denial reasons. And then I want to look at the credit environment in general, because one of the things that I don't think is talked about a lot, even if you are paying attention to what's going on with the economy, is delinquency, right? Like, we're not seeking out what's going on with consumer delinquency. Nobody wants to look into that. It's not fun. One of the things that we've seen is delinquencies have been increasing over time, especially since COVID. So late stage delinquencies have been rising across all credit tiers. When I say credit tiers, that's people who are subprime, prime, near prime, and super prime, right? So there's different categories to those credit scores, from the low end to the high end. Everyone's starting to see a bit of an increase in delinquency. We have seen, I want to point out here, let me see, you can see my mouse. February 2026, we saw this peak. And then in March, we saw a seasonal drop in delinquency. Does anyone know what would cause that sharp, quick drop in delinquency in March, or have a guess?
Taxes.
Yeah, tax returns. So people got their tax returns. And what we've seen in April, I just didn't feel like remaking my chart, to be honest. What we saw in April is a little increase again in delinquency. So people use their tax returns to get out of some debt, to pay off some past due, but then they still can't afford their day to day. So then they went past due again, right? So we're seeing an increase in general of delinquency as far as mortgage debt too. I want to bring this up in case you see headlines about it, because we went from basically no mortgage delinquency to very minimal mortgage delinquency. So if you see a headline like on the internet, or I guess that's where we read everything now, and it says delinquency has increased on mortgages by 20%, 20% of zero, going from zero to a 20% increase, it's still monumentally low historically. But it is something we are starting to see now, right? We're starting to see an increase in delinquency. It's more healthy delinquency, as weird as that sounds. It's like what our economy was pre-COVID, before we had all these programs in there that basically supplemented people's cash flow and money issues. So it's just taken a very long time to reach normal again. And I think we have forgotten what that environment looks like. But that means that now we're likely to see clients that do have some blemishes in their credit profiles. Not that there was no blemishes, no hurt, no harm from COVID. We all saw that, right? We all saw people who owned businesses or who couldn't work back in 2020, 2021. But there has been this Band-Aid that's been put on the economy temporarily that has now been ripped off. So in general, what we've seen is early stage delinquencies raising in every credit tier. So this is just another image of this, but broken down by credit tier. And why I bring this up is it's just important to know where are consumers sitting. So we're starting to see more people in that prime credit score range drop down. They're not necessarily staying in prime, they're dropping down to the near prime. And then the subprime people are staying subprime. So we've seen a little bit of a deterioration in our average credit scores over the country, in about a 13-month time frame from December through January. So let's see, let me do my math right, or my date counting right. So December 2024 through January 2026. Yep, that's 13 months. We went from 702 down to 700. A normal 12-month time frame, we see the average credit score increase or decrease by a fraction of a point rather than 2 full points. I bring this up not to say that like everything's doom and glooming and that the whole system's falling apart and everyone's going into default. They're not, but people are now feeling squeezed, and we're starting to see some missed payments. We are starting to see people focusing on how do I get out of credit card debt too. That is why you're seeing more debt settlement or that debt consolidation that was brought up. But a lot of consumers don't understand that when they're entering these debt settlement, they're calling it debt consolidation. It's not. When they're entering these debt consolidation programs, it's debt settlement. What happens is those companies, 99% of them, there's a very, 99.9% of them, there's a very rare few, the 0.1%, that actually do it in a way where it doesn't affect credit. The rest of them, what happens is that client pays them a set monthly amount, sometimes biweekly, but usually monthly. They withhold payments to all of their creditors until those accounts go into default, they're fully charged off, and then they settle for less. And the clients don't realize that their credit's being impacted until it's too late. Or when they do realize it right away, they're told, oh, don't worry, by the end of the program, your score is going to be higher because we did this. So they hang on to that false hope because they've been lied to, and then they're stuck in a situation where their credit is extremely damaged and they don't know what to do. I do think we're going to start seeing more and more of that because there is a focus of paying off credit cards, and people are seeking out professionals to help them do it, and they don't know they're being taken advantage of. That's a little bit of an aside, but so it is an interesting environment, more delinquency. People are paying down their credit cards. We are seeing utilization decrease across the United States as a whole. So anyway, that's kind of, yeah.
Can you stop right there for a second? So
yeah.
we're always looking for content on social media as professionals. You know, what do
Hmm.
we call it? Social selling. Um, I think that you could make some really good informational slides, or maybe kind of like a handout that explains the difference between debt consolidation and debt, whatever have you. And the reason why I
Okay.
say that is because I believe that borrowers are probably, probably be more open to talk to originators about their debt situation if they realize that the people that are advertising help are not going to help them. I can't stand when I hear people say, "Oh my God, all the borrowers are just like bad now." They're not bad. They're just in debt, and believe me, they're paying their bills every month. They're just their score is down because they're all the way up to the top of whatever debt threshold they're in. So if you can offer them some great advice or some other options, that was just a really great point. I don't know if you guys are taking notes, but telling people to contact you before they start to do the whole debt settlement thing because of what it really
Hmm.
is would just be a great way, once again, to have some conversations.
Yeah, yeah, you can. I mean, there's just a couple questions you can give them to ask whomever they're working with, and it will just uncover. And that's something I can get you what to tell your clients to ask, right? Um, and your clients will be able to read the writing on the wall after that, for sure. Some of the questions would be, are my accounts going to report past due? Once they have to answer yes, right? So most clients don't know to even ask that because they're having those rose colored glasses on, like, oh my gosh, everything's going to be better. My monthly payments are going to go from $1,500 a month in credit cards down to 500. That's all they're thinking about. So, okay. So we understand the environment. So now what? So how do you actually save these dead deals? So number one is understanding credit scoring. I think this is very much overlooked in general when you become a mortgage loan officer, when you're in the industry. There's not a huge and heavy focus on understanding credit, how to read the credit report, understanding why you see the number that you see for that client. There's so much you have to learn and so much you have to know that this is often skipped or overlooked, or there's just a lack of resources that exist for you to find that information. So let's dive into that a little bit. We're going to talk about credit scoring in general. We're going to start from understanding the differences between the algorithms because your clients don't understand this. And they're either directly asking you about it or indirectly asking you about this all of the time. So, not all credit scores are the same. Obviously, you see that on the screen, but what do I mean by that? We have two different primary credit scoring systems. We have a Vantage score and we have a FICO score. So the FICO credit score was that the standardized FICO credit score that's still in use was created in 1989. FICO's well before that time frame, but what still exists today that's in use is from 1989. That is known as classic FICO. That's actually the model that you're using right now in the mortgage industry. Well, what had happened historically is that there was a whole bunch of different credit scoring systems, a whole bunch of different algorithms existed, and there was no uniformity, which caused a lot of unfair or unequal treatment of consumers. And so standardization of the model occurred, and so did standardization of credit bureaus, because there used to be tons and tons of different credit bureaus. So now we have Equifax, Experian, TransUnion as our main three, right? But the government didn't want them to own the analysis tool to make the score. So they house the report information, but they don't actually own the system that calculates the score that we see. FICO creates and owns that. So that's where the FICO credit score came from. Now, in 2006, the bureaus got together and said, look, we would like to have our own credit score algorithm. We don't like that we have no control over FICO, and a lot of times passed, so they were able to do it. And that's where the Vantage score comes into play. It was created in 2006. The Vantage score is what your clients are seeing on Credit Karma. Okay. So the main like competitive point between Vantage and FICO is Vantage scores are always available for free. They're easy to access, easy to get. So they're the most prevalent score that any consumer is going to see, whether it's a bank app, credit card app, you name it, Vantage scores are probably what they're seeing. FICO, you typically have to pay for. Experian ended up offering the Experian FICO score for free, but that's really the only place you can get the free FICO score. So it's important to understand that this is not an apples to apples comparison. If you just glance here at the percentages, you can tell the difference. Payment history, 35% on FICO, 40% on Vantage. Utilization, 30% on FICO, 20% on Vantage. And there's different versions of the Vantage score where utilization's higher or lower. Payment histories on the newest version of Vantage, it's 41% instead of 40. So this is never going to be an apples to apples comparison. And what they consider, if we look at the difference between Vantage and FICO, what they consider exceptional credit also varies as well, right? On a FICO score, 800 to 850 exceptional, but on a Vantage, 750 to 850 is exceptional. It's a very different system, but they're both meant to do the same thing, which is assess risk. How much risk is a lender taking on to let that consumer borrow from them? So they have the same goal, different way of getting there, and most clients don't understand these differences. But then we go beyond that because we have some clients that are like, okay, but I am looking at my FICO score, right? How many times have you heard that? I'm looking at my FICO score. I pay for Experian. I get all 3 bureaus of my FICO score. Great, but it's still not the one I'm using, right? As a mortgage lender, you're using versions 2, 5, and 4, that classic FICO from 1989. What they're seeing on Experian site is FICO 8, right? That FICO 8 credit score, which is great. FICO 8 is used predominantly in almost every other type of lending, just not mortgage lending, right? And I'm not saying there's anything wrong with Vantage scores. Vantage scores are fine. All scores are usable scores. They're just used for different things. So we're starting to, and about 90% of lending is done with FICO and another 10% is done with Vantage now. Vantage is starting to take over the market more and more. But what clients really don't understand is how many versions of their credit score they have. And even across FICO, your FICO 8 score is not going to be the same as your FICO Classic or this FICO 254. They're never going to be the same number because what has happened is over time, if this is an old model, it's old technology, right? The newer the model, the newer the technology, the more advanced our technology, the more nuanced it can become. The more data points we have, the more nuanced means the more detail it can look at in interpreting information in a consumer's behavior to create that credit score. So none of these scores will ever be the same. Even on somebody who has like that perfect credit profile, they might have a FICO 8 that's an 850 and a FICO 245 that's an 830. Yeah, go ahead. What's your question?
Hey, I have seen a big swing between the Vantage scores and the FICO
Mhm.
scores that we pull. What are you seeing as a point swing? Because I could say anywhere between like a 30-point swing between Credit Karma and my FICOs is pretty relevant. Are you seeing anything bigger or is that pretty average?
Oh yeah, it can be bigger. Like for example, we have a client right now that has a 715 Vantage score and a 5 it's like what was it, 580 something, I can't remember the exact number, but a 580 something in FICO Classic. It can be extremely wide. That's why it's not an apples to apples. Like you can't assume if they have a good Credit Karma score that they're going to walk in the door with a good um mortgage FICO score. And one of the big reasons, oh, go ahead, sorry.
Yeah, I always subtract 30 points. I'm like, if they tell me they're 700, I'm like, oh, maybe 650, 670. I
It can
don't
be the
trust them.
opposite direction too, though. Like they can be lower on Vantage and much higher on the mortgage FICO. So there's no good gauge for an average amount of points because credit profile scoring is so vastly complex. I'm happy to dig into the weeds. Why not? Let's do it. That'll be a perfect segue. So let's dig into the weeds on how the score is made. So the next thing, which is a great segue, is we want to understand how we optimize the credit profile, but we have to understand how it works first. I tried to squeeze a lot in on this slide, so bear with me, but I'm going to focus on how to understand the FICO score because that's the one that matters here. But before we even get to looking at these weightings, here's what happens, and here's why the swings can be so wide between these two models. So let's say, so think of it this way. When we are credit scoring, creating a credit score for someone, we're rank ordering consumers. We're putting them in a row, basically. And we're ordering them into their risk. So what's their risk tolerance? But in order to properly assess risk, we would not want to compare a consumer who has 20 years of credit history showing up on their credit report with no missed payments to a consumer who's maybe 20 years old and has just a couple years of credit history and barely anything open, right? Like that wouldn't make sense. So the way that it actually starts is consumers are placed into buckets of similar profiles, similar types of credit profiles. So I call it like a demographic bucket, but it's a credit demographic bucket. So somebody who has limited credit history and not a lot of age is a demographic bucket. And depending on the version of the credit score, there's a few buckets or a ton of buckets, right? The more complex the technology, the more we've been able to create these nuanced buckets. And then from there, they're compared to others in that same bucket or others in that same category. And that's what causes an increase or a decrease in points. Does that make sense? So because of that, if I'm in bucket A and somebody else is in bucket C, what can jump my score up 10 points in bucket A may jump someone in bucket C up 50 points. It's not, you can't do the exact same thing for every single person. It's more nuanced. It's based on what makes the most sense for their credit profile and what they need. So how do we understand what's going to make the most sense is where we're going to go next. And this will be super important because this is going to be how you know what to advise your client. Because you have simulators, right? You have those simulator tools. Most loan officers have those available, but they're so limited in scope in what they can do. They really can only focus on very simple things. Very often, here's what you can pay down, and that's going to help your score. Great, that's so helpful. But not every single client has endless bounds of money to pay things off. So are there other ways to move the needle? Are there other ways to get the scores up? And the answer is yes, there are. So we're going to focus on that a little bit more, and we're going to look at these categories, but from the perspective of what you need to know as a loan officer to help your clients get those couple more points that they need. Okay? Any questions? Everyone feel comfortable so far? Okay. Now during this is where a lot of questions tend to come up, so just interrupt me and we'll make sure we talk about it. I'm going to start with talking about payment history. And again, we're going to focus on why classic FICO is different than some of the other credit score systems and algorithms and models and all of that, because that's what we care about today. Now, in the future, we'll be looking at a new version of FICO that will be used in mortgage lending. It was supposed to be released last year and then the year before. Now it's supposed to be Q4 this year. It's probably been postponed again. I haven't looked. But eventually you'll have a newer model coming out and we can talk about the differences then with that model. So if we look at payment history, this is 35% of the credit score. I think most people feel pretty comfortable with payment history. It's have you missed payments or not? But there's more to it than that. The credit score model in lending does not time weight information. What do I mean by time weighting? In every other model, whether it's a Vantage score or a newer version of a FICO model, as negative information gets older, it impacts scores less because it's in the past. But classic FICO does not do that. It doesn't have that time waiting capability. So if I have a late payment on my credit report, your first instinct is to say, okay, well, that was 6 years ago. It's not gonna matter that much. But it might, especially for somebody who has a very limited profile. They don't have a lot of open accounts. That late payment's gonna have a heavier impact because there's not a lot of data that's helping to create that credit score. Does that make sense? The other thing most people don't realize is closed accounts, closed positive accounts are no longer factoring into the credit score. You see them on the credit report, but once they're closed, they're not factoring into the score. So let's say you see a credit report and you see tons of history and you're like, "Oh, this is a robust credit report. This isn't, a thin credit profile. This is someone who has a lot of history." But if they only have 2 or 3 open accounts right now and everything else is closed, no, it's a thin profile. It's a very thin credit report. So if they do have that single missed payment, it is going to be worth a lot because all those positive closed accounts aren't factoring into their scores anymore, right? But then the opposite is true. What if I have a closed account that has a missed payment? Sorry, that missed payment still hurts you. Doesn't matter if that account's closed or open. So the missed payments have a much, much bigger impact on your credit than the positive will, because once a positive's closed, it doesn't help you anymore. So this is why when you have some clients who think they're doing the right thing, they close a bunch of credit cards, they pay off a bunch of debt before they apply for a mortgage and their score drops a bunch. This is one of the reasons. They're no longer getting the benefit of that payment history on their credit report, but they're also missing out on everything else that account was helping or calculating into their credit score. Which is a great segue into credit utilization or amounts owed. Credit utilization is focusing on primarily just credit cards. A lot of people assume that loans come into this category, but what it's focused on is what's your balance versus your credit limits. On an installment loan, right? You have a fixed payment. There's no risk because you're paying your monthly payment every single month, right? Like you're not going to get the benefit that you're paying it down faster or on the track that you're supposed to. You don't get more benefit from that in a credit report. And a lot of clients assume you do. So what matters for you to understand is with that utilization ratio, it's your balance versus your credit limit. If I have a $500 maxed out credit card, it's 100% maxed out. If I have a $5,000 maxed out credit card, it's 100% maxed out. They're both 100%. It's the percentage that matters. It's that ratio that matters. It's not the dollar amount. So if somebody has several credit cards that are maxed out and they have some that are, smaller credit limits, tackle those first because it's about the ratio. It's a volume game. The more you can get paid off, the better, right? Because that mortgage FICO score cares more about each individual card utilization than the second calculation, which is all of the balances versus all the credit limits. It's the combo, right? But mortgage scores care less about the combo, way more about each individual card. So you're going to see more score movement from focusing on just paying down the smallest cards that are maxed out first. Now, just a kind of an aside, if we're talking about optimal credit utilization, it's not 30%. So I think people get confused because 30% of the credit score is utilization. That doesn't mean card balances should be at 30% or less, right? The way where you actually see jumps in scores is, let's look at a maxed out credit card. At 100% maxed out, obviously we know that's bad. They'll see a score bump at 90%. Pay down to 90%, then pay down to 75%, then pay down under 50%. And then it's 25, 20, 10. Okay, so 10 is considered optimal. But if you have someone that has like a really robust, great credit profile, the difference between 20% and 10% is so minimal. So, just a heads up there.
The other thing I don't question.
Yeah, go for it.
And you might bring this up, and this kind of ties into the payment history from before when you mentioned, some people will start to like pay down a bunch of accounts and then close
Mhm.
them, and then it actually hurts them because it shows they have closed accounts. So,
Yeah.
like, let's say someone just is trying to get out of debt. So, would it make more sense then to just pay down things, but just leave the accounts open, basically? Because then that credit utilization will be a hundred or
Better.
0%, I guess.
Yeah, exactly.
Okay.
Exactly. And if they have, like, let's say DTI is a problem, they have like an auto loan that has a high payment, but maybe they only have $3,000 left on the auto and someone wants to gift them to pay it off, just do that as part of closing. So that way it doesn't have to be calculated into the DTI, but it's also not going to drop the score that you need to use for the loan process. Um, so that's just a better way to approach it. That's going to make sure you don't see a big drop in scores on accident.
Awesome. Thank you.
Yeah. Oh yeah, charge-offs. So charge-offs. So is everyone familiar with what a charge-off is, or should I explain? I can explain if you'd like. Should I
Yes,
just
I'm
explain?
familiar.
Okay. Okay, I'm running on an assumption. Speak now. Okay. So when an account is charged off, you now have a balance but no credit limit anymore, right? There's no extended credit limit. And you understand, of course, like an auto loan could be charged off. There's other types of debts outside of credit cards that could be charged off. But a charged off account, because there's no longer a credit limit extended or the loan itself is closed, that will negatively impact utilization because there's no available credit or no available loan, yet there's a balance. So that actually pulls down the overall utilization on the credit profile. So the reason someone will see a score improve after settling, because you don't have to pay the whole balance, they do not have to, it doesn't benefit them more or less to settle or pay off the full balance. Same thing, as long as it's zero, it's zero. That's going to help the credit report utilization, the overall utilization, okay? So this is often overlooked or people don't understand why it helps scores. It's because of utilizations. And then the last thing in this category that I think is quite often overlooked is that clients that have zero credit cards at all are missing out on what can help pull scores up. Because a credit card adds payment history every single month, whether you're using it or not. Now, you do want to keep it active. Because if it becomes inactive, then it's eventually not calculated in the score. The data isn't good. There's no good data, right? An algorithm wants solid, reliable data. But anyway, a credit card affects payment history. It affects utilization. It affects your blend or your mix of credit. It affects your average age of open accounts or length of credit history, right? It has so much impact. So somebody who's afraid of having a credit card and has no credit cards at all, they're missing out on something that could create a very, very large and quick boost in their credit score. So that is something often overlooked. And that did lead into length of credit. So average age of open and active accounts is 15% of the score. So if you have a client who just never uses their credit cards at all, but they have them and they're open, they may not be calculated in the score. They need to be reactivated. They need to use them once, and they're going to see a bump in scores because now all of a sudden it's being factored more heavily back into the algorithm. But that person who does close everything, that's the other piece that they're affecting. They're affecting their average age of open accounts. Because again, those closed accounts are not factored the same anymore. So lastly, new credit and inquiries. I don't touch on this too much right here. I mean, people are afraid of inquiries. They're really not worth much, barely any points. And the impact of everything else that's going on in credit, it overshadows the loss of 1 to 2 points very, very, very quickly. Okay. So we don't really need to focus there too much. And lastly is credit mix. This is variety of credit. The more variety there is on the profile, the stronger the credit score, because basically that algorithm is saying, regardless of the type of lending, that person can responsibly pay. So nowadays we have some non-traditional tools. There's rent reporting. There's savings accounts that report like loans that are going to barely affect DTI because you can save $5 a month or you can save $25 a month. And now you created that credit mix. You add payment history. Go ahead. I think someone had a question. I heard someone. Okay. Maybe not. But then there's also the value of the type of credit. So this really comes into play where you see personal loans are considered more high risk. The credit profile considers that as more high risk. It's a higher risk type of loan. That's calculated into the score. Or like a secured credit card, higher risk, that's calculated into a score. Unlike, let's say like a Wells Fargo credit card. It's a normal credit card. It's seen as a less risky credit card out of the other types of credit cards. A retail credit card, like a store credit card, a little bit higher risk, right? So those are the other types of things that come into play here that most people just don't realize. Any questions about any of this, or did I miss anything that somebody had a question on? Okay.
Hey, Ivory, I know that you talked very minutely about this, but there's also like that misconception that if you have a lower credit score, that credit pull is going to drop you a significant more amount of points than a higher credit score. Can you speak to that at all?
Oh, that's a new one I haven't heard. Thank you. That's good for me to know. Um, yeah, that's not
Yeah,
true.
so some exactly. But some of my clients are in that realm of like,
Ah.
let's say they're sub 600 and they're like, I don't want you to pull my credit. It's going to drop 100 points, where they're thinking that these bigger swings are affected because of the low credit that's already in place.
Yeah, it's probably something else is usually the answer because new credit is really new credit and inquiries. So this section of this 10% is really just like the flag. It's like throwing the flag up. That's all this section is for. Hey, a new account was open. We're going to temporarily drop scores. We got to make sure they can pay that new debt. Hey, there's an inquiry. We're going to have a little bit of an impact on the score because we need to make sure they're not opening 20 new accounts. But it's like 1 to 2 points. If you have like no open credit, you may see more points, but I've never seen more than like, I mean, the most I've ever seen is roughly around 8 points, but they had one open account. They were going to lose a credit score in a few months anyway because they didn't have two open accounts. Like eventually things.
Just after 10 years, it's gone.
After 10 years, it comes off the report. But if you close, okay, like, so you can't have a FICO credit score unless you have two accounts that have had activity within the last 6 months. So what can happen is I've seen even where somebody has open credit cards, but they haven't used them in so long that there's no score because they're inactive and they're stale. So basically, rule of thumb, you just have to have ideally two open and active accounts, and that's pretty much it. And then you can have a FICO credit score with 6 months of history. The reason they're introducing Vantage is because you can have 1 month of history and have a score. It's very different. Anyway, I don't know if I answered your question fully, but hopefully.
Yeah, that's just a misconception that we hadn't covered. So I was like, I don't know if it's like a stigma with lower credit that's an assumption, but
Yeah.
it's one of those things.
Yeah, that's a new one I haven't heard. That's interesting though. No, it's usually going to be something else, maybe a new collection or maybe something reporting more recently or something like that. There's so many things that go into it. It's hard to say. And then I just like to point this out too. The reason I wanted to go through this is because you can use this understanding and then look at your credit report and see what are the factors contributing to the scores that you're seeing. So I would show this one because even on a high credit score or higher credit score, there's still going to be factors that are detracting from that score being perfect. Okay. And so it's going to rank these based on what's the most impactful. So the top 4 to 5 most impactful will typically show up here. And you can use this to your advantage to know, okay, well, this is really what's going on. This is what's driving the score I see primarily. Can I fill in some of those gaps? This one's obvious. Balance versus credit limit. You pay things down, right? Length of time accounts have been established. So they don't have enough age on their profile. So that could mean, does their spouse have a credit card that's been open for a really long time? If the answer is yes, maybe they just get added to their spouse's credit card as an authorized user. Now we just knocked out one of the biggest detractors from their score, and that's going to help pop their scores up. Too many accounts with balances. Now we know it's a numbers game, right? We want to tackle as many of those small cards as we possibly can, if they have small cards, obviously. Number of accounts with delinquency. You can't really do anything about that unless you're doing credit repair yourselves, which I don't think most loan officers are doing that. But obviously that would be, you have to get rid of delinquency. It has to come off the report if you want to tackle that category, or you crowd it out, right? We can crowd things out by adding good information. Are there credit building tools that they can use to add onto their credit report? Does their landlord allow them to report their rent, right? Like there's other ways you can tackle delinquency without having to remove it. It can be adding more positive so the delinquency doesn't overshadow the report so much.
Oh, that's a good question.
Yeah.
Does self-reported weight the same as a business recording?
The self-reported, oh, it depends on the algorithm, is my short answer. So FICO Classic will not calculate in certain tools. Like, for example, Experian Boost. You've probably seen it on your credit reports. It's not affecting your clients' mortgage FICOs at all. It's affecting the newer versions of credit. Rent reporting, depending on how it's done, will affect some of the classic FICO. The credit building accounts like Self, if you've heard of Self, the savings account that reports like a loan, that will affect classic FICO. Kickoff, that will affect classic FICO. There's certain things that will affect classic FICO and others that won't, unfortunately and frustratingly enough. But there's still things that can be done. The newer models, you can use it all, and it all affects it. But we have to be a little bit more strategic right now until we start using these new credit algorithms. I think that's about that. That's about it with that. Okay. Now, the negative accounts. Okay, so we saw this. Delinquency. It exists. What do we do about it? So I'm going to jump into this side of things. And if you've worked with anyone in credit repair before, you may know some of this. If you haven't, a lot of this will be new to you. I'm not naive that there is a lot of negativity around credit repair in general. There's good credit repair and there's bad credit repair. I want to be very clear. You want to run and hide from the people that are going to tell you that they can guarantee everything can be removed from a report. They can get it done in 60 days. You know, they're making all these promises. Loads of bologna sandwiches. So let's look at what's actually realistic, what to know and what to understand is possible. That's so important because you need realistic expectations, because you also want to make sure you're passing that on to your client if you do end up referring them to credit repair. So credit repair is supposed to be compliance analysis, okay? What I mean by that is real credit repair is based on laws and regulations around credit reporting and the behaviors of bureaus, creditors, and collection companies, okay? It's not stupid templates that guarantee removals or all the baloney that you see all over social media. There's so many trends where they're just spouting just completely factually inaccurate things, but they sound like they're telling the truth and like it works, so people believe it. That's really unfortunate. So the main two sets of laws that are used in credit repair, and there's more, but these are the main two, are the Fair Credit Reporting Act and then the Fair Debt Collections Practices Act. So to really make things super simple and summarize the Fair Credit Reporting Act, all reports have to be accurate and complete. So said differently, no missing information, no inconsistent information across each bureau, because to be accurate, they must match. No errors, obvious, right? Data can't be wrong and nothing's obsolete. So that doesn't mean you're saying a consumer was not past due. If they were past due, they were past due. Now, if they weren't past due, obviously you can say that. But real credit repair is not just writing to the BS, prove to me I was delinquent. If you can't prove it, then I never was. Like, you see a lot of that over social media. That's not how it works. And with collection companies that are third parties, they do need to have proper documentation. They do need to make sure they're not reporting debt that's too old to put on the credit report. And then, of course, they have to follow state laws in addition to the federal. States have their own overrides that are far beyond what federal law requires in many cases. So a lot of debt collectors are buying pools of consumer debt at once, meaning they're not necessarily doing their due diligence to make sure that debt is valid in the way of having proper paperwork, right? Um, if they do not have proper paperwork, then they do have to delete it. So I'm gonna send you this page, and we're almost done here. I'm gonna send you this page afterward because we don't have time to go over it. But these are negative credit facts that tend to surprise loan officers. They're very helpful for you when you're looking at a report and analyzing it. So I want to show you what credit reports look like and credit report errors look like. So when you are looking at a credit report, you're seeing it. Oh, I don't have the full shot here. Sorry. When you're seeing the lender report like this, you're not getting all of the details or all of the information. So when we pull credit report for finding those compliance issues, those errors, we're going to pull them from annualcreditreport.com. So if you're working with or if you're interviewing a credit repair company, one of the things you can ask them is, where do you get your credit reports from? And they're probably going to use some sort of a monitoring software so they can get scores, because these reports don't give scores, but they should always be telling you that they also get them from annualcreditreport.com. The reason why is because these are the official and legal reports, so they contain data that no monitoring platform has, and the bureaus themselves on their own consumer interface don't show all the data either. So this is the only way to get all the data. So let's look at what errors look like. I don't expect this to mean that you're going to be an expert in finding errors, but I want you to have that understanding so you know what credit repair is. So if you do refer clients over, you know what we're doing on the back end. So let's start with this first example. Example number 1 right here is about missing information. And this is just a snip. I'm not going to show you a whole page. But in this person's profile, we can see that it's blank. There's no data here. There should be green check marks, just like this. We go from no data to 60 days, 90, 90, 150, blank again, and then all of a sudden charged off. Well, where's the on-time payments? Where's the 30-day delinquency? How did we go from no 30-day to 60? Why are we missing information here? And then why is it charged off there? I think it's obvious what the errors are on here. There's a lot of issues there. Then if we look at this other example, on the surface, it might look like nothing's wrong. We went from on time to 30 days past due. Then they repossessed the vehicle, which they can do as early as 15 days past due if they want. So that's fine. And then they probably auctioned it off and they charged off the remaining balance because it didn't sell for enough at auction. There was still some due. But unfortunately, they messed up on tracking the amount past due, because this is August, September, October 2023. August, oh, my circle's in the wrong place, but August, September, October 2023 are blank. And then we've got December, a random monthly payment, then 14, 7,000, then 5,000, right? Like, it doesn't make sense. So those are errors. Another one, another great example, this one's so easy, straightforward. Like, a client could dispute this themselves, right? There's no balance, there's no past due, there's no scheduled payment, yet I'm marked 60 days. How can I be 60 days delinquent if we don't even have any data on the delinquency? It should look like this. So what is disputable? This is certainly disputable. This is not, right? Because that looks right. It's probably right. We check the statements and verify. But let's say this gets deleted and it's updated to on time. Now we go from on time to 60 days. We may have another dispute there. Like, there's some strategy involved. And this is why I want to bring up, when you're looking at a report, it's not a matter of whether that client was past due or not. Let's be realistic. Most of the time they were. It's about, are the bureaus compliant because this creditor could have set all the right details to the bureaus and they just failed to properly report. So what disputing is essentially, and I'm just going to skip this because we basically covered it. What disputing is essentially saying these are the problems, okay? And then the bureaus either have to fix it or delete it. Bureaus typically opt to delete simply, and it's been very, very, very rare that they actually fix it. They delete only because it costs them less money. Like that's the only reason why. It costs them more time, more money to have someone manually go in and fix things. And then there's risk involved with that because what if they don't fix it properly? Because the real risk is if they don't fix it properly or they don't fix it at all, they can be sued by that consumer. Because again, these laws are consumer protection laws, which means if they're not followed, the consumer has the right to litigate against the bureau, right? So it's less risk and less money for them to delete. Anyway, so that's a really long-winded way of saying that's how we put together dispute letters. They're going to be based on every single error and issue, and they're not necessarily going to match across each bureau. Like this is one credit bureau, this is a different credit bureau. That's another credit bureau. So there's 3 different bureaus, obviously, Equifax, Experian, TransUnion, but they structure their credit reports differently and they're going to have different issues. So let's look at what this all putting all of that together that we went over, what this looks like in practice with clients. And then we're going to look at the loan officer side, and I promise we're done because I'm so long-winded. We went very long. So we had a client who was referred by a loan officer. They were ready to move forward on a refinance for an investment property. But there was a $2,500 Incite collection that was a business collection listed on their credit report, their personal credit, of course. It ended up being actually a fraudulent account opened by an ex-employee. Unfortunately, because of that being on their credit, their scores dropped to 743, 720, 733. And the refinance didn't make sense. They couldn't get a good enough interest rate to do a refi. The numbers just weren't lining up. So we got it deleted in a month, and that client was able to save an additional 0.375 on the rate. So they ended up moving forward with the transaction. So this would have been a lost transaction for that loan officer. And instead it was just delayed a month. So that's more what we're talking about in the beginning. It's a month delay. With a profile that was pristine like this was a person with an 800, there wasn't a lot of opportunity for optimizing the profile. You just had to focus on the negative. So that's one scenario that can happen. Another scenario is we had a client, they had a family business. I mean, they had a lot going on. They were very wealthy, but they didn't pay attention to their credit because they had a lot going on. That's not uncommon, unfortunately. They had collections, they had late payments. It took roughly 5 months for them to get there, but their scores ended up in the 700s. So they were able to he was moving to Arizona. He bought a home in Arizona, and then they were able to do some more real estate investment too. So it's very possible from mid 5s to 700s in a short amount of time. It doesn't have to be this year wait. And then here's a nice recent one. So this is one of those situations where we have a processor that does work with us. She had this one referred over. We didn't know if this was going to end up being able to happen, but they referred on April 10th. They had a mortgage delinquency, collections, charge-offs, actively past due on an auto and a credit card. How many people would think like, okay, this is done? Like it's just not going to happen. We have 60 days to qualify them. Not realistic, right? I'm going to talk about these scores that you're seeing too in a second. So pre-approval ended up occurring on May 25th with a mid score of 635 for mortgage scores. Do you remember how we talked about the Vantage scores and the FICO scores and how the mortgage score calculates things differently? This was a case where this score is lower than the mortgage score, and this score was much higher than the mortgage score. This is why it's not an apples to apples. So one of the things we'll do is we'll say, hey, it's time to pull credit. The mortgage score will look good. But we got so many things removed from their report. This is just one of their updates. They had another. I just can't fit everything on the screen. But so many things were removed, and they followed every single credit building piece of guidance, and they paid every single thing off we told them to. So they were able to make the impossible happen. Now, we did get lucky and we got the mortgage delinquency off, because we couldn't have done that if we wouldn't have been able to do the transaction if it didn't come off, because we can't have the delinquency within the 12 months. And we had them cure the active default. They even got a new collection on their report, and it was still able to close. So this is kind of one of those Hail Mary tosses over. Sometimes people that it doesn't look like can qualify truly can faster than you realize. And then I thought it would be helpful just to show you what a real loan officer's pipeline is. I know you literally can't see anything, but I wanted to show you. They started with us in June of 2025. They referred one client in June. They're like, we're not sure. We want to test you out. Fair. That went well, so they started referring more as of October 2025 or later. Since then, 6 have funded so far, with one being a $2 million mortgage for a couple who started in the 500s. It took exactly 6 months to get them to qualify. And they were in debt settlement. They were one of the ones who didn't understand how debt settlement worked. So out of 17 borrower opportunities that they referred over, 11 became clients. 6 are still active with us. Or, well, not quite. I think it's 5 now. It was really late last night when I was putting this together. So the conversion rate's 64%. So that's several clients that were not able to make it to the finish line. Okay. So there's a lot of opportunity that actually exists if you have the resources. And there's several times where we've also just told her, just tell your client to do this, and then they close, right? They don't always need us. But, she didn't get to learn about the optimization, so we just have to give her the answers. So anyway, I just wanted to put in perspective what that looks like. The rest is kind of mumbo jumbo, just putting it into numbers. We don't really need to talk about it, but I suppose this would be the other thing that kind of helps to look at is one of the other important things is knowing what should be paid and what should not be paid. So for clients, one of the things we'll do is we want to challenge the collections to see if they have the documentation, because in this case, there's $320,000 that clients would have had to spend on collections that they got to put towards credit cards or towards other things, right? Having that strategy around what should be paid is super important, especially with limited funds. But that's it. That's all I have. We don't need to talk about the rest because I don't have time. I've talked too long. So any questions on anything?
I have a quick question. I
Yes.
noticed in one of the slides on that one profile, because I see this a lot too with the buy now, pay later accounts, like the
Oh, yeah.
Affirm, the Klarnas. So, like
Yeah.
that snippet said, I think it said it's not gonna help your credit history, but any negative could hurt. So, are
Yeah.
those counted as part of the credit utilization or not really? It's only there, and if it's bad, it hurts you, and if it's good, it doesn't help. Is that kind of what it is?
It's not really factored into the utilization so much. It's here, I'll show you what it's looking at. I'm sorry, close your eyes from all the movement. So the problem with those buy now, pay later accounts is people get them because they think, oh, this payment history is going to be great. But the problem is it affects length of history so much while they're open. Because they're short-term accounts by nature, some of them are 3 months. I've seen them for 1 month even. I mean, like, why are you anyway? So that is adjusting the average age of open accounts on their report. And it's not uncommon if someone's done it once, all of a sudden they start using it more and more and more, and then you see 10 of these open. It doesn't matter if they have good age on their profile. When you have 10 accounts that are 3 month accounts or 6 month accounts, and they're all open, it's just going to weigh your profile down. So it's not helpful at all, and people think it's more helpful. Now, somebody who has like no credit history, they're probably the only ones who might see a little bit of a benefit from it. just because they don't have a lot of history. It's some data, but I would still never ever recommend someone use it.
Okay. Yeah, the amounts of times I have to get all those stupid statements because of their bank statements, the payments to a firm, Klarna,
Yeah.
it's so annoying.
Yeah.
Thank
Yeah.
you.
Yeah, absolutely. What other questions does anyone have?
On that case that I have about the client that has the debt consolidation, I noticed
Yeah.
her credit cards are closed, but she
Mhm.
has a monthly payment. How
Right.
bad is that affecting her credit?
So that's going to be affecting her utilization for sure. There we go. It'll be affecting her utilization because there's no extended credit limit and there's a balance. So her utilization is going to be all out of whack. And I don't know what program she's in. There are some programs where they don't mark you past due. Most they do. Obviously, if she's being marked past due, then it's going to affect payment history. But if she's not, it's primarily just going to be this. And then probably the age dropped too.
Okay, thank you.
Yeah. Yeah. What other questions?
I had a question. Great presentation. You put up some fabulous slides here. Is there any chance that we might have a copy of these slides made available to us?
Yeah. Yeah, I can send them to you. That's no problem.
Awesome.
I'll get everyone's emails from Dionne because I don't have access to that part. And then I'll send them your way. Yeah, you can have whatever slides you want. I don't mind. And I definitely want to make sure everybody has this. I just talk so much so I didn't have time to go through it all, but this is really, really helpful. I think personally, for anyone that has negative, any of your clients that have anything negative on their report, it's kind of like a cheat sheet to understand um, what you could expect as far as timelines and what's possible and all of that.
Totally agree.
So, yeah. Other than that,
Can you
like,
share your information again?
yeah, sorry. That's my info. If you have clients that need credit help, we do that. Obviously, we can help with that. Um, we do have like a partnership portal where you can see what's going on with all of your clients. You can track their progress, and all of that. We send monthly updates. So, like that other slide I showed where I talked about the buy now, pay later, loan officers get that email with the client every single month. So, our goal is to basically keep up with that part of your pipeline, but we prompt you for connections or check ins so you don't have to worry about it. Because there's a lot of other plates you're trying to balance and keep in the air at the same time. But yeah, if you do have questions on reports, we can just review reports, tell you what's going on, tell you the answers. Otherwise, obviously, we know some clients do need that extra help, and we can support you there, obviously too. But there is a lot of hidden opportunity that exists. A lot of people out there that are driven, they want to get a mortgage, they just need the resources and tools to get there. So, anyway, yeah.
Thank you.
All right. Anyone else
Someone
have
asked
any?
about the cost for a client to
Oh,
work with you.
we have different programs. So we have a Credit Score Pro is a platform we created that's DIY. So for that platform, they just pay for the credit reports. So it's free, but not really because you're paying for the reports. So that's for people who just can't afford much. For people who truly can't afford anything out of pocket, we do litigation. So with the litigation, I kind of hinted at it. It's consumer protection laws that we're utilizing. So we create disputes, but then we sue the bureaus when they don't fix things. So that's an option for people who have no budget at all. Because the way we charge is on contingency. When there's a settlement, we take a portion, the clients get the rest. So that process is a 1.5 year process to 2 years. So that's only for people who have a long timeline and just don't have the out of pocket funds. Otherwise, for everyone else, we have our main programs 170 a month. That's the super comprehensive one where I showed you a picture of the disputes. I got too many slides here. These. So that's a super comprehensive one. These disputes are We have some that have been 30 pages plus for clients. And then for our other program, it's like a trimmed down version. That one is $50 a month. So very, very much trimmed down, but this is like the cream of the crop. This is how we get so much off credit reports, but we're a premium service. So I think standard pricing is usually about $150 for most credit repair, just to give you a comparison. But we'll do it for $170 and usually a little bit more success rate as far as removals, just because of how we do it. So, yeah. But we'll talk to when we do a consultation, and we'll talk them through the different programs, and ultimately they just choose if they want to work with us or not, and then what program they want. So we always do a full review of the annual credit report with them before they decide if they're going to work with us. So, any other questions? Okay. Well, if something else comes up, my email again, after I go through the slides back and forth a million times, is right here. Feel free to reach out to me. That's my phone number too. Just dial extension 1, or if someone else on my team answers, they'll just route you to me. But yeah, feel free to reach out if something comes up. I'm more than happy to be a resource. Cool. Thanks, everyone.
Thanks.
Thank you.
Thank you.
Absolutely. Bye.